Expedia reported earnings, fourth quarter 2022 earnings to be precise. The market did not like what it saw from the travel company. So let's dig into the big numbers from this report, try and understand why the market sent this stock down after the results were announced. Overall, the big key was that Expedia saw hints of a demand slowdown. Now, revenue increased by 15% in the fourth quarter to 2.6 billion. Adjusted earnings per share of $1.26 increased by 19% from the fourth quarter of 2021. So double-digit growth in revenue and earnings per share. This part of its earnings was solid. Booked room nights jumped by 19% to 70.8 million. But here is the key thing. Here is what I believe sent Expedia stock downward and what had investors a little bit concerned is that the ADR for booked room nights fell by 1%. This was the first time that booked ADRs were down since the second quarter of they should say 2020, since the second quarter of 2020. So this is a troubling trend because the travel rebound is gaining momentum. Folks are unleashing pent up demand for travel, and this has caused an increase in what they're paying for the average daily rate. That's what ADR stands for, average daily rate, for the rooms that they're booking. And this is good news for Expedia because it gets a percentage of the overall adjusted daily rate. So the higher these go, the higher Expedia's revenue goes. But more importantly than that, it's an indicator of consumer demand. If ADRs are falling, that means that consumer demand is also slowing down, which is a bit troubling because travel has still not rebounded to the level where it was before the outbreak. We're still several $100 billion below annualized spending, below where we were before the pandemic. So it's a little troubling to see this slowdown begin before we've recovered completely to the pre-pandemic annual spending rates. It might just be a blip, a one-time thing. And 1% decrease is small, but it's just the reversal of the trend that I think has investors concerned. Gross bookings increased by 17% to 20.5 billion. Now, gross bookings measures where consumers booked overall, right? So it doesn't measure the per room rates, just overall bookings, how many reservations consumers made, travelers made, and for how much those reservations were for overall. Those increased by 17% to 20.5 billion. This growth was despite severe weather, which was a significant headwind for Expedia, and this could be another explanation why booked ADRs fell also. Cash flow from operations decreased to 3.4 billion in 2022. This was down from 3.7 billion in 2021. The company used this cash flow to reduce its debt. It paid off $2.2 billion of its debt in 2022. That's going to mean lower interest expense in the future, right? Because debt comes with interest expenses. If you have less debt, that means less interest expenses, which is going to be good news for its earnings per share over the next couple of years. And it also bought back $500 million of its stock, indicating to me that management thinks its stock is undervalued. And travel is one of the industries that I'm bullish on because of what I mentioned earlier. A few $100 billion of pent up consumer demand that has yet to be fully realized, comparable to before 2019 levels. So I think this stock over the next couple of years is going to be fine. The sell off here is a bit of investor caution coming out of the decrease in average ADR. All right, as always, I really appreciate your viewership. Thank you for watching, and I hope to see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.